watch my first video, I talk about a swing trading approach that you can attempt. Obviously, I do day trading. So I used to do swing trading because the job that I have would not allow me to day trade. But now I finally understood that I could do day trading. Why? Because of the timing element that I have come to understand in the recent years. By the way, I have been trading for 5 years. Specifically, I've been trading step index offered by Deriv. And when I started trading Deriv, I traded all of the markets that are supplied by Deriv. I would be on volatility 75. I would be on step index, volatility 25. I would be on crash and boom. All of these markets, I wanted to try all of them. So you can tell that I did a lot of mistakes in these 5 years. So in each video, I will just touch on what I used to do back then that derailed me from my success. Well, that's the number one lesson that I have for you. I traded a lot of these markets. So now I trade only one market, and that is step index. And I have mastered my craft. Trust me on that one. I don't play. I've mastered my peer, step index. And if you love trading step index as well, give me a thumbs up because, man, I have germs in this particular video. So hopefully you are ready. You have your note-taking materials, your pen and paper, ready to jot down these germs that I'm going to be providing in this video. All right. I have a blank chat. I found this on the internet and I decided to teach through this medium. Of course, I'm going to transfer to a live chart because you are interested in what's going on in step index, of course. But if you bear with me for a little while, all right. So suppose that we have a key level on the higher time frame. We always want to start on a daily time frame or a weekly time frame or a monthly time frame. Those three time frames that I just mentioned, they are called the high time frames. Your bias for the month, for the week, for that particular session, it has to be derived from the higher time frame. It's very important because you don't want to get lost in the lower time frames. This intraday formation of price action, just gyrating, moving up and down, will get your emotions jacked up because you are only looking at lower time frames without understanding how the big picture is forming. Price is always telling a story. If you understand how the story is unfolding, then the lower time frames are going to be much easier for you to trade. So I have down here a horizontal line. Take this line as your support on the higher time frames, maybe on a weekly or daily, and price is coming all the way down into your support. And as you can see, it is hovering above that key level. It doesn't touch the key level, it hovers above that key level. And it moves away for a little while. When it comes back and it goes all the way down to suck all of the individuals that would have traded this move to the upside. Now, I don't trade this particular move, honestly. What I like to trade is when the market comes down to sweep that low. So when the market comes lower to sweep that low, it also reaches down into my higher time frame support. All right. Obviously, if I have a bias that I am deriving from the higher time frame, that the market is only coming down here to support on this key level, if I am anticipating that the market is going to go up, then I will need to drop down into my lower time frames for me to have a low risk buy. Because I cannot just buy the markets on a higher time frame, I need to drop down into lower time frames. So this particular low that I would be buying has to be aligned with time. Time is very, very important. Time and price. If price reaches down into a support and it is not the time for that key level to support, meaning that if it comes into my support at a wrong time, then it would not be a high probability long position to the upside. But if it comes down here at a seasonal time, at that particular seasonal low, the market is poised to go higher. It will be much, much easier for the market to move higher at high speeds, or a market that moves in a quick direction to the upside, meaning that there is a huge amount of volatility that is injected in that key support from the higher time frames. Take, for example, the mid-month of June 2025. Those are the kind of trades that I'm interested in, good people. One directional. Sweet, beautiful. It is timed. I knew where the liquidity is, which was the mid-month high. And I knew the entry. I knew everything about that particular trade. It can be timed, good folks. That is what I'm going to be teaching on this YouTube channel. So let's hop on into step index on a daily time frame. Time in Forex is like the seasoning in a stew. The stew representing the Forex market. The stew represents the Forex market as a whole. It's a complex mix of ingredients, your currencies, your economic factors, political events, etc., constantly interacting. Of course, in the Riv, we don't apply that here. That does not apply. However, bear with me in this analogy about time. So the seasoning, which in reference to time, time is like the seasoning. You can have all the ingredients for a good stew, but if you don't let it simmer long enough, the flavors won't meld properly. Too little time, quick decisions. Trying to trade too quickly based on only short-term movements, it's like tasting the stew before it's simmered. You might get a few individual flavors, but you won't understand the overall taste or how the flavors will develop. You are likely to make a rushed judgment and potentially add too much of one spice or not enough of another. The right amount of time, which meaning patient trading, letting the stew simmer for the right amount of time allows the flavors to blend and create a rich, complex taste. In trading, this means understanding the broader market trends, allowing your trades to mature according to your strategy and not picking over short-term fluctuations. Too much time holding trades too long. Letting the stew simmer for too long can lead to overcooked vegetables or flavors becoming too concentrated. In trading, holding on to losing trades for too long in the hopes that they'll turn around can lead to significant losses. Sticking to your plan and predetermined exit plan, even if it means accepting a loss, it is crucial. The key takeaway of this analogy is that patience is essential. Forex trading isn't about instant riches. It requires patience to analyze the market, develop a strategy, and let your trades play out. And the time frame matters. Different trading styles, scalping, day trading, swing trading, position trading, require different time frames. Knowing your time frames and sticking to it is like knowing how long to simmer the stew. Time can be a friend or a foe. Time can either work in your favor by allowing trends to develop and your profits to grow, or it can work against you by eroding your capital through losses if you're not careful. So, understanding the long term trend is important. The taste of the stew depends on how long it simmers. The overall movement of the market depends on the bigger picture. So, in summary, using time effectively in forex trading is about understanding the market's rhythms, being patient, and using time frames that align with your trading strategy, like a well-seasoned stew. A well-timed trade can be a rewarding experience. Now, with that being said, good folks, I have step index on the daily time frame in here, and we're gonna reference the beginning of the year, January 2025 opening. And remember how I spoke about time element back when I was referencing the opening of June, which can lead to a volatility injection, which can be fast market, it can be quick, one directional, it spools to attack certain liquidity pools, or it comes down spooling really quickly to fill in inefficiency. It really does two things. It's either it's attacking liquidity or it is coming down to fill in inefficiencies. I had already made another example with this particular week opening. So essentially, every time when the new week begins, or the new month begins, or when the new year begins, it has a it has an expansion moving higher or lower. But in this case, for January, we did not see that expansion. Instead, we had price action consolidating up until February. Also, February was a bit of a consolidation as well, up until February 20th. Time, good people. The element of time. 20th February 2025 printed a fair value gap. So at this particular time, the 20th of each month, that is when I will be active in the markets, analyzing for a potential setup. Right? So at the 20th of February, price action attacks the buy side in here, moving really quickly. So when it comes back this particular month of April, what is it doing in the 20th February 2025 fair value gap? Well, It is rebalancing that inefficiency, and it is offering you a swing trading opportunity, going all the way up to attack all of this relative equal highs. I would treat this February 20th of a fair value gap as the opening fair value gap for the year 2025. So a lot of importance on this fair value gap, a lot of importance. Look at how many times it came into that fair value gap, and look at it again here. Look at it again in June. But there is a problem this time of the year. June. June represents the other half of the year. This time, we are not coming back to support on the 20th fair value gap for long positions. No. No, 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 son. We are coming down here to offset and destroy liquidity pools that were accumulated in the previous 6 months time. I know where the liquidity is. I just look back 6 months. What has been the trend? It has been one directional, going to the upside. Of course, price action does not move in a straight line, but this would be a crude depiction of the trend 6 months ago. It has been offering support on this 20th fair value gap. So yes, my good friends, you could have been one directional, going to the upside and ignoring short positions in the previous 6 months. Yes, high probability trade conditions were favoring the longs, going bullish. That is what the previous 6 months offered in terms of high probability. But this particular 6 months going forward, the high probability trade conditions would be favoring the shorts. We are attacking all of these liquidity pools that have formed 6 months ago. And especially the consolidation that has occurred in the beginning of the year. So this is a swing trading opportunity for you to attack the beginning lows of the year. We have the 12th February 2025 sell side liquidity. This is where, for the next 6 months, this is where price is going to draw back into. And this particular fair value gap for the 20th February 2025, we're going to want to see that fair value gap being broken down and being traded as a resistance to go lower and attack this particular swing low or the lows of the previous 6 months. That is what I have for you for this particular video.